The global financial markets are bracing for a week of potentially market-moving economic data and geopolitical developments. Investors will be closely watching macroeconomic indicators from major economies, including inflation figures, industrial production data, and consumer sentiment surveys. These releases come at a time when central banks worldwide are grappling with persistent inflation and slowing economic growth. Geopolitical tensions continue to cast a shadow over the global economic outlook. Energy markets, in particular, remain sensitive to developments in Eastern Europe and the Middle East. The ongoing war in Ukraine and OPEC's recent production cuts have added to supply concerns. Investors are closely monitoring the situation for any signs of escalation or easing of tensions. In the United States, the Federal Reserve is widely expected to maintain its hawkish stance on interest rates. The latest inflation and jobs data will be crucial in determining the pace of future rate hikes. Europe faces its own set of challenges, with the European Central Bank caught between supporting a fragile economy and taming inflation. Amidst these uncertainties, investors are seeking clarity on the direction of monetary policy. Clear communication from central bankers will be essential in shaping market expectations and navigating the path ahead. This week, the spotlight will be on key U.S. economic data releases, including the Consumer Price Index, Producer Price Index, and weekly jobless claims. These indicators will provide insights into the state of inflation, business pricing pressures, and the health of the labor market. The Federal Reserve will be closely scrutinizing this data as it weighs its next move on interest rates. Market participants are eager to see if inflationary pressures are continuing to ease. A slowdown in inflation could give the Fed room to pause its aggressive rate hiking cycle. Conversely, stronger than expected inflation data could fuel expectations of further rate increases, potentially dampening market sentiment. The jobs market remains a bright spot in the U.S. economy. However, the Federal Reserve is watching for any signs of softening, as this could signal a broader economic slowdown. A tight labor market can also contribute to wage inflation, which the Fed is keen to avoid. Europe continues to grapple with a challenging economic landscape. The energy crisis triggered by the war in Ukraine has cast a long shadow over the region, contributing to high inflation and slowing economic growth. This week, investors will be keeping a close eye on Germany's industrial production figures and the European Central Bank's economic bulletin for clues about the health of the Eurozone economy. Germany, Europe's economic powerhouse, is facing significant headwinds from soaring energy costs and supply chain disruptions. The ECB is facing a delicate balancing act. It needs to raise interest rates to combat inflation, but excessive tightening could further weaken the region's already fragile economy. The energy crisis remains a major concern for Europe. The continent is heavily reliant on Russian gas, and efforts to secure alternative supplies are ongoing. The situation highlights the need for Europe to diversify its energy sources and accelerate the transition to renewable energy. Across Asia, economies are adjusting to shifting global monetary policies and undergoing significant transformations in their technology sectors. China, the world's second-largest economy, is navigating a delicate balancing act between supporting economic growth and managing financial risks. Japan, grappling with deflationary pressures for decades, is experiencing a shift in its monetary policy stance. China's recent moves to ease monetary policy and support its property market have garnered attention from global investors. The country is also undergoing a significant regulatory crackdown on its technology sector, aiming to address concerns about data security and market dominance. Japan, traditionally known for its ultra-loose monetary policy, has surprised markets with recent moves that suggest a potential shift towards policy normalization. The Bank of Japan's actions reflect a growing global trend of central banks moving away from accommodative policies.